FM 89.3.
So Money FM 89.3.
Listening to Money FM 89.3,
Singapore's most influential radio station.
This is Prime Time on Money FM 89.3.
It's time for Career 360.
You're listening to Hashtag Wanderlust here on Lunchtime. I'm Timothy Go.
Welcome to Weekend Mornings here on Money FM. Glenn Van Zutphen with you.
Good morning. It's the Breakfast Huddle.
Money FM 89.3. You are indeed in the Breakfast Huddle with me, Manisha Tank.
You're in Money and Me. I'm Michelle Martin.
About a month away from the announcement of Singapore's budget this year.
What drives your passion on the issue of mental health?
Tuesday was a good day for market.
Will the UK still be part of the EU?
So how are careers being disrupted today? That's hopefully something we'll address.
Welcome to Art of the Deal.
We're at the Mercedes-Benz Center for our second edition of Money at Work.
Money FM 89.3.
All right, thanks for joining us this Friday evening. My name is Ryan Huang. I'm from the morning show on Money FM, the Breakfast Huddle. And you can catch me every day, 6 to 9 a.m., where we talk about business and personal finance. And of course, we also cover what's shaping market sentiment and how to invest your money. And this is an extension of that, this webinar, where we have a chance to go a bit deeper into all the topics we want to cover. And this webinar will try to help you beginners how to get started investing. And today's topic, of course, is how to get started investing. For parents, how do you construct your child's portfolio? And that's something quite important to kind of prepare for, because things are getting more expensive. And you might have observed it yourself, when you were in school. Those school fees are now getting more expensive. And also, just a shout out for last week's episode. You can find it on this Facebook page as well. And the first episode was with Michelle Martin and her guest, Gabriel Yap, where they shared how you can build your S-Streets portfolio. So you can check out the videos on our Facebook page. So back to today's topic, investing for parents. And I'm curious to see what sort of crowd we have today. So in the comments box, if you can, type in how old your kids are. So they'll also help us to test if the chat function is also working properly. So I'm just going to give you guys a couple of seconds to test it out. And there's also a poll in the comment section. So we are running that as well to kind of get a sense of what's going on and your point of views, right? So the first question, if you've seen it, what is the best investment so far? Is it stocks? Is it property? Is it insurance policies? Or maybe even your children, right? So I'm going to give that a few seconds to get running. Of course, our guest today is Dawn Cher. She is also known as SG Budget Babe. And this is also something that resonates with her as well, because she is also a young parent. And for many of us, we've been taking care of ourselves for a long time. And if you're a young parent, you kind of have to adjust to things. You now have a dependent, a young kid. enough to plan for their future. And many of us would like to give them a head start. So maybe give them something we didn't get the opportunity to do. And that requires a lot of forward planning and investing. So let's welcome Danker. She's also known as SG Budget Babe. And her financial blog receives about 10 million visitors every month. Hey, Dawn, thanks for joining us.
Hi, Ryan. Thanks for having me. Hi, everyone. So my name is Dawn, and I write at sgbudgetbabe.com.
Yeah, so let's talk about your financial blog, right? What actually got you started on this journey? Tell us a bit more about yourself.
Yeah, sure. So it actually was like a side hobby to begin with. I've always loved writing, and when I was young, I really wanted to be an author. But Asian parents, right? So a lot of them just didn't think much about the literature, or and they were like, oh, how many famous authors who are rich in Singapore can you name? So it's not a very viable career. So my childhood dream basically got shut down. And then next to the internet, so I've been blogging for ages. Actually, the moment I think in the early days, I was already blogging when there were days of like live journal and Tumblr and stuff. But then in 2014, when I started the blog, I really wanted to make something more formalized, and I thought it'd be interesting to kind of not just write about where I've gone for lunch or what I'm buying or what I'm doing, something that would be more value adding, something that's like kind of like a notebook for myself. So that's how I started. Yeah, and in a flash of an eye, it's been like 6+ years. I honestly wasn't expecting so many people to enjoy and appreciate the content that I write, but it's great that it's getting that kind of value adding to people's lives.
Yeah, and interesting to see as well, looking at the poll results, we have 70% of people voting for stocks as the best return on investment. And Dawn, you also have a young kid, right? So how has that changed the way you see things, right? Investing for the future. What comes to mind now when you think about how the cost of living is going up?
Wow, I think honestly, our expenses have gone up tremendously ever since having a kid. I wasn't expecting it to be so expensive. Yeah, and nobody ever told me stuff like preschool fees are so expensive, because I think of the moment you kind of get conscious, right, is when you're in maybe like secondary school or later primary. And when I used to ask my parents, hey, mommy, daddy, how much is my school fees every month? And it was like a single digit. So I never ever once knew there was like hundreds plus or 1,000 plus in preschool fees. And that's like really insane. And yeah, expenses have definitely gone up. I think I if not for the fact that cost of living and all of these expenses have been going up so quickly, I may not have invested for my kid, because we've always been doing investing for ourselves, for our retirement. But I think at the stage things are going, we cannot not afford to invest at all. So yeah, that's what today we'll be sharing about that, and I hope you guys will find it useful. Type in your questions if you have any below.
Yeah, so this topic really resonates with me, because I have a young kid as well. So her name is Raylin. So you can see some of us have this growing up phase photograph album. Right? And behind me, you can see all the toys on the red shelf. So a lot of things going through my mind right now. How do we prepare for the future? What do I need to get started? And with the price of things going up, what do I need to watch out for? And before we get to that, we also have to run through the disclaimer. So I'm just going to put it up on screen. Of course, this is something we run on every seminar. We want you to be mindful that not everyone's investment appetite is the same, and also not everyone's objectives is the same. So be mindful of that as you absorb the information today. So this is the the usual disclaimer you see on every webinar. So Dawn, you're sharing a photo just now.
Yeah. I don't have such a nice one like yours, so mine only has like a photo of my son on the screen.
How old is your son right now?
He's almost 2. Very close to yours.
So that is a long way to plan.
Yeah.
Okay, so let's get started, Dawn, with your presentation. So you have the numbers, the thesis, why it's so important to get started.
Yeah, exactly. So yeah, usual disclaimer on the screen. today's session is, I'll try to cover as much as I can in our sharing today. But at the end of the day, remember that investing is very much customized to each of your personal life. So yeah, please make sure to do your own due diligence. But I think most of you who are here today will find today's session useful in understanding how to invest. So I'll get started. I think it's interesting that a lot of people chose stocks as the answer. That's also something that I personally believe in. And the reason why it's so crucial for us to invest in our children's future is because, we're talking about cost of living going up. But the other big thing that has happened and is really centering in today is on inflation, right? We've all been watching and reading the news about the Fed pumping in so much money into the markets ever since the COVID-19 pandemic and the economic meltdown began. And it's crazy, a lot of that money is on a unprecedented scale. Even during the 2008 crisis, they didn't print as much or as quickly. So all of this money printing or unlimited quantitative easing, QE for short, is going to lead to inflation. That's what people believe. If, for example, we do not find a way to be more efficient in terms of our productions and goods and services, the supply, okay, with more money circulating in the economy, but the same number of goods and services, prices will inevitably increase. And if that's going to happen, we're going to be in trouble. We've already seen in our generation how food has become from 50 cents chai fan to today it's like $2.50, $3.50, $4. I don't even want to imagine how it's going to look like 10, 20 years from now.
Yeah, especially the price of property. I think when our parents were growing up, things were, $30,000 for BTO, and then now it's really up to 1 million for some districts. So that is really a reflection of how things are keeping pace to some extent, inflation and also other pressures. And now we have a poll as well. If you can go to the Facebook comments page, the comments section, you can see the second poll now up. How much do you think your child's university education will cost you? First option, 100K, 300K, 500K, or maybe 700K. So give your vote to the comment section right now, and we'll give you a couple of seconds before we show you the numbers. So that might shock you. So I'm going to give you about 10 seconds just to put in your numbers right now.
I think it's also that consideration of whether you're going to send your child to local or overseas universities. So if you think that you need to plan or that your child will most likely end up in local university, then vote for the one that is at local stage. And if you think that your child may be sent overseas because maybe you yourself studied overseas, then vote for the one that's overseas.
Okay, so right now we have about 32% voting for 100K, and it's a tie right now, I think, between 100 and 300. So that is pretty much where the vote is. So, Dawn, are they correct?
Well, let's take a look. So I'll talk about local first. These aren't my numbers. So there's this really great article in Dollars and Cents that you guys can check out. And they basically projected what the fees were in 2017 and used the inflation rate all the way up until 2035. If that's going to be the case moving forward, then for non-medicine costs, that would be at $130,000. So those of you who voted $100,000, that's pretty much what you're looking at. But if your child has, greater noble aspirations of being a doctor and saving lives, when they want to be at the forefront of, future pandemics and stuff to basically help people and help the human race, that's going to set you back by more than $300,000. For those of you who are curious on how that breaks down right now, also you probably want to consider whether your child's going to go the JC route or the polytechnic route, because the cost for each is actually quite significantly different. Right. And DBS has this really good graphic that I like that shows the breakdown in the current rates right now. I think this article was last year or so. So it's pretty accurate, at least also when I look at the numbers. But that's just for local universities. Let's take a look at how overseas universities is expected to cost. So again, this is credited to DBS, but yeah, by their projections in 10 years' time, overseas universities, which is already costing $200,000 to $300,000 right now, is going to be $300,000 to $400,000+. And if your child is much younger, like mine is, by the time they enter university, it's going to be 20 years from now. I don't even want to imagine how that's going to look like. Were you expecting these numbers, Ryan?
Wow. It's quite expensive. So you might have to take a loan on that. And then if you do take a loan on that, that will take some time to clear. So something to take note of. I mean, some of you might have gone through that yourself as well, having to borrow money to go through university. So it is going to be a long journey to plan for this.
Exactly. But the good news is we can start early, right? And as savings, the same concept goes to our retirement, and we can apply that to investing for our children's future. The earlier you start to save, then the less painful it will be, because you get time on your side and you have compound interest to help you grow that figure to a more sizable portion versus you having to save up all by yourself at a later stage. But if you were to invest this, that could be even greater returns. So I like this graphic. Again, credit to UTBS. They have lots of great content, but I really like how they presented it in this way. Although it is kind of debatable whether government saving bonds is so close to keeping up with inflation, because the way I've been seeing it, it doesn't seem to be that close to the inflation line. Of course, if you leave it in the bank, okay, they say that some deposits are not going to be helping you even keep track with inflation, and you in fact be losing money as time goes by. And then you have the usual suspects like endowment, unit trust, and stocks. So we will cover which option would be best for parents who are looking to invest for their children. But this is great. I have a different take on it though. So I'll just share with you my own personal interpretation of how each of this stack up. So starting from the bottom of this pyramid, this is basically my own model. I still think, I disagree the very first one, which is putting it in the bank is actually lower than inflation, because we're in an era right now where high yield bank savings account have been coming up pretty much. And if you actually use the right bank savings account that gives you higher yield on your savings, anywhere between like 1.8 or even 3%, if you can consistently hit and cross those hurdles, then that can actually be a good way to beat inflation, right? Another way that I think every Singapore parent should make use of is your child's development account. And I'll talk about this and how we maximize it as well. The next level up, would then be on fixed income, endowment, bonds, Singapore saving bonds, and even gold. So this would be portfolio or instruments that are not as risky and hopefully would give you at or more than inflation level, right? And then if you want to go take on a little bit more risk, that's where you can look at your exchange traded funds, unit trusts, and even your robo-advisors. These offer great access to stocks and managed funds, and that can help you to basically invest in market returns across a diversity of stocks in order to set up your child's portfolio. And of course, at the apex of this pyramid, the way I see it is my personal preference is to go for stocks, because while it does require a little bit more active work and due diligence, it also has the potential for the highest returns, which is similar as what you've seen in the previous slide. So we're going to go through each of these, although I may not touch on every single method today, but this is a really good portion to kind of think about if you want. You guys can go ahead and screenshot this page if you like and see what fits your own risk appetite and the returns that you're looking to get. But on the child development account, I think this is a really great tool that Singaporeans should definitely utilize, because as you give birth to your first and second child, you'll get $3,000 from the government in your CDA first step. All right. From there, if parents actually put in another $3,000, the government does dollar for dollar matching. So that equates to a total of $9,000 in your child's CDA. And the child development account right now is at 2% interest, provided that doesn't cut, because in today's environment, lots of bank interest rates are changing. But if that doesn't change, 2% is actually a pretty good rate, right? It's better than the 0.05% that you typically get on your other bank savings account. So if you go on to your third and fourth and your fifth child, you can see your payout increases accordingly. So if you were to really maximize this CDA, all right, what you could do is basically get your child's initial investment sum to a sizable portion, 9,000, 12,000, or 18,000. And if you're wondering, but where do I find that $3,000 to put in for the dollar-to-dollar matching? Well, you could take it from the baby bonus, right? So the baby bonus, I think for the first child, the government gives out, I think, 8,000. I can't recall. It's been 2 years ago. But yeah, so you could, like, what we did was that once the money from baby bonus came in, we put it into a CDA account, and we're just going to leave it to compound the interest over time. It's been close to 2 years now, and it's actually quite decent. So I would encourage you guys to consider the CDA first if you're a parent here in Singapore. Okay, so what's next? After the CDA, right, we will talk about you can also explore high yield savings account. There are some accounts out there that give you pretty good interest. But what about, the other stuff like endowments and all? Well, in our era, especially mine, the families of my generation, what our parents did was typically going for endowment plans. And if I did a quick search on Money Hour's website because there's a comparison tool that you can use. And right now I'm seeing this is not a recommendation, by the way. Okay, I literally just did a search and this came up as so-called best value, right? So projected return is 3.67, and I basically put in a monthly premium level at $300 because we don't want it to be too painful, but it can't be too little as well, such that it doesn't have enough room to grow. Of course, if you have more money to spend, you can put in, like, let's say $700 consistently every month, then the payout would increase. I think it's like 500 or 700. I can't remember. Okay, but go ahead and play with the two and see what is the kind of returns that you can get, both on guaranteed as well as projected. So this basically is the premium duration of 10 years. We pay for a set number of years and then it runs, and we get the returns at the end. We can use this to pay for the child's university fees. It's actually not a bad way to save up for university at all. All right, but if we are looking at such high costs, it really depends on how much you put in and what you get at the end of the day, and also what course your child wants to go for, right? Because we've seen, if you go for medicine versus non-medical, local versus overseas, there's a big difference on that. So I've always been thinking about, what if my parents were savvier? What if they had invested in a stock market instead of buying an endowment plan? My parents didn't buy me an endowment plans, but my cousins had them, right? So what if our parents had bought stocks instead? Now, I think about stocks that existed during the 1990s, okay? Because that's basically when I was born. I'm like 30 this year. And, if I go back to my birth year, right, there is this one stock that was already pretty big in the 90s, moving on to the 2000s as well, and that was Microsoft. And if my parents had actually spent $5,000, okay, investing in Microsoft, that amount would be $1 million today. So that's incredible. And $1 million is going to be more than enough to save up or even pay off your child's university fees, as well as, give them a little bit more spending power for the stuff that they want to do. If my parents had done that for me, right, what we could have done is, at the point where I went to university, we could have withdrawn part of that money, and we would still have money left after paying my university fees to let me maybe like buy my house or pay off my wedding and stuff like that. So that you can see the big gap between investing in stocks and investing in endowment plans or other methods of other instruments that you use. So the key thing here is to pick what works best for you. Different risk, different returns. Okay, so you have to manage that accordingly. Now, I'm sure at this point in time you might be thinking, and this is a question I get a lot, hey Dawn, but I'm not savvy at investing. What if I choose a stock that goes the other way instead? What if the stock doesn't exist anymore, the company goes bankrupt, the company folds, all right? What if I invest at the wrong timing? People who invested at the start of 2020, some of them might still be in the rate right now, depending on where they put their money, because after COVID-19 hit, there was that 30% crash in the stock market in March, right? So would timing matter? Now, here's one thing I'd like to share with you guys. In a recent webinar I did with Endowments, we also shared about how time in the market beats timing the market. And even if you were the worst investor in the world and you were to invest 100,000 consistently at every point before a crash, okay, so this would be like 1973, and then markets dive 37%. In 1987, invest again, market dive another 20%, so on and so forth. And the worst would be in 2007, invest at the peak of the subprime mortgage crisis, and then see the markets drop by 53%. But even if you did that, up until now, you would still be in the green because markets have trended over time upwards. So having time in the market beats timing the market. Whether or not you're great at predicting bull or bear, pick or louse, okay, you don't really have to be too worried about that. So we're going to take a short break now for some questions to see if you guys have any questions on the investment portion. So we'll take a quick break here.
Yeah, so if you have any questions, please put them in the comment section. And right now, I'm going to put on the next poll as well. So this poll is interesting because we want to ask you, how are you planning to pay for your child's university fees? Have you given a thought about it? Is it going to be investing in financial products? Is it going to be borrowing from the bank? Or maybe going to let them figure out themselves when they grow older? Or you just don't have any plans right now? So give us your thoughts in the comment section. And also, if you have any questions on Dawn's previous slides in the past few minutes, please also share them with us. And Dawn, I noticed you talked about Microsoft just now. Of course, hindsight is 2020, and people are just wondering, hey, it's easy to say when you're looking at it now. But I think the lesson here is to look at look at diversifying your investments as well. It's not just picking one investment that might do well.
Correct. Yeah, of course. You're right. Hindsight 2020. So Microsoft is just one of the many stocks that have done well, right? And there are ways for people to diversify easily. We're going to cover that in the second part of this, right after the Q&A break. So if you guys have any questions on the front parts, because after all, this is beginners, you're spending your time tuning in. We want to make sure that you guys walk away with some value, with some knowledge, with some skills. And if you have any questions, be it CDA or, how to invest, whether timing the market really matters, stuff like that, just let us know. But, Ryan, I picked Microsoft because I thought that was a really good one. And already at our point in the 90s, right, Microsoft was already relatively big. It was, in a lot of households, it was very, very visible in that sense. Almost everyone was on Windows. There was no Mac at that time. And then, maybe there was, but it just didn't get as much traction. So I didn't know of Mac until much later. And we were all using like Microsoft Office, PowerPoint. So, it's a great way to start thinking about what are stocks or companies that will still be around in the future. So a lot of people, for example, say, I want to support the next Amazon. But sometimes the next Amazon is Amazon, right? That could be one perspective of looking at it. Yeah, so there's a lot of ways to invest. People who are uncomfortable with just one stock, of course, you should diversify. And you should never put 100% in one stock anyway. That's like, that's really playing with 0 and 100, which is really, really bad. Yeah, but we're going to talk about the different ways in the second part of the slide. I have a quick question. Did you know the CDA hack before this?
Oh, okay. I've briefly read up on a CDA, so I was quite, I guess, to a certain extent, familiar with all the nooks and crannies of the CDA thingy. So yes, but it is a very interesting thing to bring up, and I think it's quite useful for a lot of people to know how to maximize your use of the CDA. I'm just going to look at the poll results right now, and it's interesting. 55% of you, that's the top choice, are saying you will invest in financial products to prepare for your child's education. So then maybe it's a mix of insurance, life policies, maybe it's stocks. And interestingly as well, 10% of you will say, let them figure it out. Well, that is, I guess, crossing the bridge when you get there. Dawn, what's your thoughts on financial products? What are some of the things you think are worth looking at right now when it comes to long-term planning for a child's education?
So I think people need to think about what their risk appetite is first, because you need to start from there rather than thinking like, what product is good. First, you need to think about what is your risk level. What makes you sleep well at night? Are you very emotional, which means like if the markets crash, you're going to immediately sell everything? Are you able to deal with that? And that should be the very first thing that parents do rather than going into which instrument itself.
And then we have a question. It is how to pick the right stock. So it seems like right now the markets, blue chips, telcos, banks, and REITs are all tanking to some extent. When, I guess, is the right time first is to get into the markets, and how do you pick what is the right stock to buy?
Yeah. For me, right, it's all about going through a very analytical process. And I think that's super important because if you don't do your due diligence, then it's very easy to fall into the trap of following hot stock tips. I'll use an example, right? When the SIA crisis was happening on social media, on internet, and even when you talk to people, okay, a lot of folks were saying that SIA will not die, the government will not let our national pride die. So it's safe to go and invest in SIA stock. But I held a webinar back then. And I told my readers, for all those who tuned in, I said again, due diligence, but this is just my own personal take. And I felt that was a very dangerous way of looking at it because if you know how liquidation works when a company goes bankrupt, the stock owners, right, the stock investors are at the very end of it. Right? All the creditors and everything gets paid first, and then the investors are right at the end. Retail investors are at the end of the scale. So I didn't think it was good. And at the end of the day, because we don't know how long COVID-19 would last, we had to think about what companies would have good, strong balance sheets to survive the crisis. It's not about whether they'll be safe or built up. It's whether they can survive the next few months. And if that becomes longer, would they have enough runway to do so? So I avoided SIA like the plug. And now looking at SIA stock price, I'm really, really glad I stuck to my guns. During the crash in March, I made several moves as well. Some of them are still stagnant. A lot of them are actually already in the green. So it's really about doing that research. And I can definitely say, right, when you ask people, hey, what stock to buy, everyone's going to have a different opinion. So that's why investing is kind of both art and a science. You have to know the science of it. And then the art, right, which is the judgment, is very subjective. And your judgment is going to vary based on how much research you've done. If you don't know much about the airline industry, okay, your judgment may not count for much. If you know a lot about the oil and gas industry, then your judgment probably counts for a lot more. So I'm always ready. I always tell my readers, right, oil and gas is not my circle of competency. I don't really understand it. It took me investing in the 2016 oil crisis to realize that about myself. And so stick to the stuff that you understand and you can have conviction in. That's the best way to identify if a stock is worth buying and if it's good.
Yeah, Don, maybe you can take a step back and walk us through maybe a peek into your portfolio. How did you get started picking those stocks? What's in that portfolio? And what is the type of process when you go through? Like, do you maybe park aside a certain sum of money to buy every month? Or is it a once a year purchase to build up that portfolio?
Okay, so I'm gonna go through. You guys are gonna have to pick into my brain later. Okay, the third part of this sharing is exactly how I choose those stocks. But let me address that question, which I think is a great one, which is how do you put in, right? For me, because I do a lot of research and based on my schedule, okay, I don't do monthly investing. That is great. A dollar cost averaging method could be great if you're doing a more passive approach. So in order to understand which approach works best for you, let's take a look into the next portion. All right, so I'm gonna start now on how I invest for my child, right? And this is things that you guys have to think about. How much time do you have? Okay, that's really important because let's say if you're a super career woman or you're like a MD at your company, you're on a fast track career growth path. And you don't really have a lot of time at the end of the day to be investing and doing all this research and due diligence because any time after work and on weekends belong to your family, your friends, and socializing. So if time is very, very limited for you, then an active stock approach may not be the right method. Maybe something that's more passive that wouldn't require as much effort from you would be a better pick. Because, right, if you don't have time to really research and then you go in, that's dangerous. And if you don't have time to exit when it's time to exit, okay, if you spot initial red flags happening, that's going to be a problem. I'll share one painful lesson I realized. During my maternity at the end stage of in the third trimester, because I had a very bad fall. So, it was dangerous and I took a step back from a lot of things, including investing. And as a result, right, I missed a very, very big red flag in one of the companies I had invested in Singapore. By the time I noticed it, the stock was literally too late to sell. Yeah.
Oh no.
And then it got
Which
suspended.
company was this?
I don't want to say later. Later got implications, So yeah, but it really showed me the importance of, you might want to think about how your time fits in. That's super important. Yeah. And this is where if you don't have time, maybe a passive approach would be better. And I'll talk about how in a minute. Yeah. Another thing that I look at when I invest for my own child, so his name is Nate. Okay, when I invest for Nate, right, I think about teams that grow in terms of what companies would be like. The Microsoft of my era, okay, is a great behemoth right now. What could be similar in his time? What would be relevant in his time? People say print is dead. Okay, I don't know if that's going to be true. I think print is going to evolve rather than die out completely. Okay, but you need to think about what is going to be relevant in our kids' time, 10, 20, 30 years down the road. And that's how I pick stocks that go into Nate's portfolio. And the last thing to really consider is your long-term outlook, because you have to think wider. If you think very short-term, okay, you want to go into turnaround plays like SIA in your child's portfolio, then you better make sure you have an exit plan. I generally don't trade much because I find the in and outs too emotionally draining and too time-consuming for me. I rather spend the time investing and researching on good stock that I can simply buy and hold for the long term. So you have to really consider these three main factors. And one word of caution, I would say, for fellow parents, right? You know, as parents, we're always very reliant on word-to-word recommendation. Yeah, sorry, mouth to mouth, yes. Okay, so anyway, like, you know, if you want to go to a school, you ask all your mommy and daddy friends, hey, which school does your child go to? Is this brand good? Is that other brand good? So we live a lot on this recommendation. Please do not apply the same metrics when it comes to investing in stocks. Yeah, that's really, really dangerous, all right? So I need to emphasize this because during the March crash, right, I saw a lot of dangerous comments on social media, and you know, I was really tempted to go in and like, if you guys have followed me, sometimes I'm just very, you know, I just scold people. I'm like, please don't do something so stupid. But I didn't want to, like, you know, put myself out there and kind of get slammed. So I just shut my mouth. But on my own webinars, in my own blogs, I was saying, you know, you really have to be careful. And these are some stocks that I wouldn't touch now, and don't just rely on what everyone's saying. Yeah, so that's something to really think about. So that's how I invest in my child. So once you guys have the answers to those questions, you'll be able to decide which tool is better for you. Okay, that the more passive approach, I think robo-advisors are a great way for anyone who doesn't have a lot of time and expertise to actually start investing for the long term while still being able to focus on your career and spend time with your family and friends. Another great way is if you want to put in a little bit more effort, you can spend a little bit more time, then what you could do is to invest in the ETF directly, because the robo-advisors basically choose the ETFs that are great for their portfolio based on their own investment strategy and approach. Okay, like SIFE, for example, they basically do okay, I should switch to the next one first. Yeah, so SIFE, for example, they have a core satellite approach, and they have a philosophy on the rebalancing and all. Okay, the ARI approach, and as a result, right, you go into those robo-advisors website, you can actually see what are the ETFs that they invest in. So if you want to be a bit more proactive, you could directly invest in those ETFs instead of going through a robo-advisor which has a little bit of fees stacked up on top of that. All right, and then of course there's the DIY option. So before you pick your tool, okay, I think it is also important that you look at what is your portfolio allocation. Because I give you an example, right? Some parents may have more than one property, and maybe they want to will it to their child, right? Or some of them may have, you know, a lot of like, maybe they bought bonds, they bought gold and stuff. So depending on what you already have in that overall portfolio, okay, this is where you then want to think which is better for you. Because for example, right, if you're spending a lot of time on property trying to do rental yield for your child, that's quite time consuming, then you may not have enough time to spend on the stock market, and that's where maybe a robo-advisor solution would be better for you. But you know, if you don't have property, you don't have the capital to buy a property for your child anyway, or use that as a means for investment, then you know, REITs, which are real estate investment trusts in the stock market, which hold portfolio of properties, and it's kind of like you being a landlord and collecting rental, just that the rental comes in the form of dividends by these REITs, okay, then that could be a better approach, and that would fall under equity, and you can park it under property if you want. So first thing is to come up with that holistic asset allocation. For me, we don't have any property to give Nate, so unfortunately, the property side will have to be through REITs, okay, but for bonds, right, we do use CPF a lot, because I love the returns on the CPF. It's quite controversial. Some people don't really like the CPF because of the liquidity issues, but I think if you use the CPF with your advantage and you do voluntary top-ups to, let's say, their MA or even their OASA, it's actually quite good. You know, the returns 2.5.
What bonds are you buying now that's beating CPF?
Sorry?
What bonds are you buying now that's beating the CPF returns?
Oh, my CPF is my bond. So I don't actually buy bonds separately. Yeah, I used to
Right.
think bonds were great, but I no longer do because CPF I think is the best bond out there.
Okay. I think it's very interesting. You brought up robo-advisors and ETFs. That's a great starting point for a lot of beginners to go into the world of investing, because a lot of it is automated to some extent, and you actually pay an expert to figure out what's going on. So there is a bit of management fee involved, a bit of a small commission, but it really takes away a lot of the work, takes care a lot of the work for you. So that is a trade-off between DIY and I guess ETFs and robo-advisors.
Yeah, you kind of pay a minimal fee to the robo-advisors to do it for you. It's so much better actually. You know, in the past they didn't have so many robo-advisors or any robo-advisors at all, right? Then your option would be going to like the bank and getting them to invest it on your behalf, or maybe buy an investment linked plan from insurance. So the fees can really, really add up. Robo-advisors, by combining human expertise and tech, has actually brought that down by a lot. Yeah, so I would go ahead and read this fabulous article by Dollars and Cents, which has a complete guide to robo-advisors. I haven't studied all of them, but my personal favorites are like Money Owl, Scythe, and I quite like the DG portfolio because of how accessible it is as well. But yeah, pick your own preference. Okay, there's no right or wrong. All right. So the other one, okay, is that if you were to go into the ETF, do it yourself through an ETF approach. So exchange traded funds, ETFs, are basically stuff that gives you a wide exposure at once. You buy one counter and you get exposure to a lot of different stocks at one time. So for example, if you wanted to get the top stocks in the US, okay, the Vanguard S&P 500 ETF would be a great way to achieve that kind of diversification. So for those of you who say, oh no, I feel a bit scared that I put $5,000 in Microsoft, I don't think I could do that. Well, you could put that into an ETF instead that's spread out across all these companies. And the great thing about ETFs is that when one goes out, okay, one company goes down or exits the ETF, then the fund managers basically are the ones who replace it with another one. So you don't have to worry about it at all. It's quite easy. Okay, and there are lots of ETFs domiciled in US and Ireland if you want to get over the tax portion. If you wanted to add on more, okay, you could do, this is a sample ETF portfolio that I have put together, for instance, to illustrate. Please don't go and buy this and take it as a recommendation, okay? But I thought, if you want something that's holistic, this could be one way of thinking about it. Because, for example, okay, you get exposure to the US 500 companies through the S&P 500. Then you can get exposure to China through the Vanguard Total China Index ETF, which is listed in Hong Kong. You could also get access to the internet plays, okay, internet companies in US through the First Trust Dow Jones Internet. And then if you think that healthcare is going to be big because of aging population and medical advancements, then you could go into, let's say, an ETF like the iShares Global Healthcare ETF. If you think that banks in China, we have seen how banks in the US made a lot of money and have grown over time. Now with China becoming the world's second largest economy, if you believe that the same track will actually happen for China financials, you could go into it through the Global X MSCI China Financials, which is listed in the US. And finally, if you want to go but not buy the actual physical gold bars, okay, then you could even buy an ETF for that. So there's ETF for so many things like oil, gold, silver. I remember there used to be a ETF for obesity, which basically plays on like what would happen if obesity became a bigger theme of the world. So
you can almost invest in any theme.
Yes, that's right. There's a lot of options out there.
I think you brought up a very good point just now. If you are a bit worried about putting all your money in one stock, the ETF by construction helps you to diversify into many different stocks. So it is one way of diversifying your portfolio. And of course, you can buy multiple ETFs to even diversify further. So that's something to take into consideration.
Yeah. If you guys want to learn more about ETFs, just search for the term index investing. Okay, so that's index investors are basically people who tend to invest in ETFs directly instead of the underlying stocks itself. So the last option, the last two, but actually there's a whole lot of tools. I just think it's an easy way of breaking it down in these three options. You can see I go from like least effort, easiest to a little bit more effort, and then the most number of effort, all right, would then be on the DIY approach. So here's a sample again, a sample portfolio. Again, these are just examples. It's not a recommendation. Okay, I'm not saying that you should go out there and buy these stocks now, but let me explain why I use this as examples. Say, for instance, you want to create an equity portfolio for your child with stocks that are going to be around in 10, 20, 30 years' time. So Tesla, for example, if you believe that electric cars are the future, okay, and that they are the number one, okay, then Tesla would be a pretty good play. Okay, if you want to also look at China, Tencent is a pretty good play. In fact, I've talked about Tencent since 2018, and people who attended my very first investment workshop back then, right, and heard about Tencent, I think if they had made action, they'll be smiling right now. But Tencent's a great play on the China's economy as well. Then, in Singapore, out of the three banks, actually our three banks are all pretty fantastic, but my favorite has got to be DBS in terms of the growth. And I think Piyush Gupta is a great leader. So as long as he's in charge, I think DBS is going to flourish, right? And then SGX, investing in the stock market itself is always is one of the better plays as well. And if you look at SGX history, it has been pretty good. Management is also pretty great. So that probably is still going to be relevant 10, 20, 30 years down the road. Or Alphabet, Google, for example, right? Google, now, we always say in marketing and branding classes, right? The moment your brand becomes a verb, that's when you know you've really made it. And we're all saying things like, let's Google it now, right? So I think Google's going to be even bigger in the future. And Alphabet could be a great way to ride on that growth. MasterCard, if you believe in cashless payments as the future, that could be a great play. Mondelez, they do food and snacks. Okay, that could be another one. P&G, they're basically in charge of almost every toiletries that you see in your bathroom. Okay, and a whole lot of other skincare products. So, and then of course, if you want like property, Parkway Life REIT, which owns like hospitals in Singapore, that could also be a very good play. So there are actually a lot of stocks that you can think of. If you just look at the Singapore stock market, there's already like, I think 600 to 700. If you look at the US, wow.
Slightly disappointed you didn't put SPH or SPH REIT on this list.
This is just an example. Yeah, I think SPH REIT, when they maneuver into nursing homes, is also a pretty good one to watch. I have to admit, though, I haven't really studied it in detail. Yeah, so that's why.
Interesting question coming through from Sean He. Thanks for your question. So many discount brokers do not allow accounts to be opened under a minor's name. So you end up opening multiple brokerage accounts under your own name sometimes. So how do you keep track of all these different portfolios? I have my own way, and I use actually an Excel sheet. Dawn, what about you?
My way is the same as yours.
So I have multiple brokers, for a bit of organization, because within each broker you have your own ledger or your own diary which they track. So that helps to some extent.
And I think it also depends on what platform or tool you use, right? Like, okay, I haven't really read too much about it, but I read one article saying like FSM1 seems to have something where you can actually do the parent and child thing. I'm not sure, okay? So please go and ask them because I'm not their representative. But yeah, maybe that could be one to explore. I also know that in Endowments, if you use Endowments as a robo-advisory solution, they have this option in the tool where you can actually segregate it out. Yeah, so it depends very much on your tool. But for those, right, if you use, let's say, Interactive Brokers or Tiger Brokers or any other of the usual suspects, if they don't have it, then I think the easy way is just Excel, Yeah,
let's jump back to your Tencent case study. I think not everyone might be familiar to the business model behind Tencent, what it entails, the full extent of it. Walk us through why you think it's such a great opportunity to get in.
Yeah, so Tencent, as I mentioned, I've been talking about this non-stop since 2018, which was the year I discovered it. Tencent basically, right, is one stock that I'm super bullish about. In the next few minutes, you're going to take a walk through my brain and see how I go towards analyzing the stock. So Ryan, I hope that answers your question from earlier on. So let's go into it. So Tencent, quick introduction. They're listed in Hong Kong. Market cap has grown. When I first saw it, I think it was like 2 or 3 trillion. Now it's like 4 plus, hitting 5. Wow. And the revenue is incredible at 375 billion RMB. Gross profit is also extremely favorable. And the price to earnings, though, it might be hard for some value investors to stomach, especially if you follow rules like PE cannot be more than 15, otherwise it's overvalued. You may not be able to invest in such stocks. Okay. But for Tencent, it's a growth stock. That's where you may need to look at other metrics instead. And I'll talk about valuations later on. So let's look first at Tencent's growth. Okay, I couldn't manipulate Google to show 3 years instead or 2 years. But I think in 2018 when I first started talking about it, it was hovering at about mid 300s. Then it dropped slightly. And then, today it's like, wow, $510. Actually, I think it's 507 today as of closing. So how did I go into this and why am I so bullish on it? Okay, so what I usually do, and you can go to my YouTube channel as well, to where I do lessons on the 4 approaches that I use, which is business. And I do the business, after understanding your business, I do a financial health check. And then I look at the valuations and I then look at the management quality. Yeah. So wait, I see actually a really good question. Should we take that now? I see someone asking, is it too late to buy Tencent now? At the price is very...
That's a good question. Because expensive can get more expensive. The price can go higher. So that's a very good question when you look at things like Amazon or Tesla, which is actually 300 times price to earnings right now.
Yeah, exactly. So I think, at every point, right, you're going to have people asking, and you are also going to ask, is it too late to buy now? Is it, if I miss the boat? But here's the thing, good companies will often surprise you on the upside. And they continue to grow over time. Okay, as the company grows, their share price usually also then reflects that. When it was already 300 plus, people were already saying it was expensive, right? When Tesla was 800, Elon Musk said it was too expensive. He tweeted that, then boom, crashed until 700. And then look at it now. Wow, it's like 1.6 thousand. So, you have to make that decision. And one way to do it is once you understand the business and you have done the financial health check, then you have to look at the valuation and I think the management quality. My good friend Serging has a really good quote that I like, right? And he says, sometimes management is the best moat that the company has. And I love that quote. Yeah, so let's look at how I would look into Tencent. So for those of you who are not familiar with Tencent, okay, they're one of the biggest companies in China. It's not just Alibaba. So Tencent doesn't get as much attention as Alibaba or Jack Ma, but they're also really pretty good. Most of you probably have heard of WeChat, especially since now WeChat's at that middle of the Trump versus US Trump versus China conflict. But they don't just do WeChat either, So they're in social media, they're in games, they're in healthcare, they're in software, they're on entertainment, they're even on platforms. WeChat Pay is one of the top 2 payment systems in China. In fact, when I make my trips to China, I only use WeChat Pay. Yeah, so they do lots and lots of stuff. And analysts estimate that more than 2/3, so that's like 2 and 3 of the 1.4 billion population in China use Tencent. That's a lot of consumers, right? And if we look at the revenue growth, okay, from 2015 until 2019, the revenue growth has been really, really incredible, really healthy. I love looking at this kind of numbers because it shows me the company is growing year on year. And that's important because year on year growth is what's going to help with the stock price as well. Now, let's look at how that breaks down. So I don't just look at overall growth because I need to understand the business. I look at which division and whether, is there a problematic division? Because some companies suffer from this, right? They have so many big divisions, especially the conglomerates. And then one could be pulling the rest down. So I would be looking at each and every one of them. And you can use the sum of the parts analysis if you think that's great for you. Only use SOTP for some stocks like Disney, Tencent. But generally, I just try to get an overall understanding first before I go in-depth into the numbers. So looking at Tencent, right? This is from their latest annual reports. I haven't factored in Q1 and Q2 this year because I tend to only review my numbers every year. So for those of you who ask how much time I spend, right? I only review existing positions at the point where I buy more or at the point where they release their next annual report. Yeah, so just once every year, not that much of an effort. I spend more time looking out for new stocks and new opportunities and monitoring the existing ones. Yeah, so in terms of divisions, right? They have value-added services. So gaming, they're the largest gaming company in the world. Gaming and social network falls into this. You can see year on year, right, is 13%. Okay, fintech and business services has been one of the star highlights recently. So they're at 39%. And online advertising is still a little bit slow, but not too bad at all. It's 18% right now. And then for all other services that can't be classified into the top 3, then that's at 56% growth. But note that the other are like, I think other, if I'm not wrong, includes their investments and a lot of the other miscellaneous business units. So that number is also smaller in terms of revenue. It's just 7.5 out of the entire 377 billion. But because they're small, it can also grow at a faster pace. So if you want a graphical look at it, here's how the annual revenue of Tencent from 2008 until last year looks like. It's incredible, right? And I can tell you at every single point, people were always saying, it's too expensive, it's too expensive. Will the next blue column look even higher? That's your guess as much as mine, but I am pretty confident that it will be. So I don't think it's expensive at all. Okay, so for social media, right, Facebook and Tencent are at the top of the social media league. In fact, some people say Facebook and Tencent are pretty much equal if you compare. Facebook is the US side, international, Tencent is for the Chinese. And, they don't just serve the local Chinese in China, right? Because there's also a huge population of folks who speak Chinese but are not from China, as well as overseas Chinese. So, and when you want to do business in China, let's say your suppliers are in China, your customers are in China, you probably are also going to be using WeChat for marketing and your payments as well. So it's huge, right? I love the business. I think it's a great one. Now let's look at the valuations. Okay, this is where it can get quite subjective. Okay, because what is expensive? It's for this 8 times earning expensive. But hey, if you look at the price to sales ratio instead, then that looks a lot more palatable. Now it becomes 9 times. Right? So which one are you going to focus on? That's something that you have to answer. Okay. There are the science out there that teaches you what you should be looking at. But what I always advocate and what I strongly believe in, I try to understand how the good investors do it. So I would go through books, I would attend their courses, I'll try and learn their secrets. Okay, I'll take a walk through their brain, like what you guys are doing right now with mine on Tencent. And in understanding how they analyze and what they place more priority on versus less on, that's when I make my own judgment on what I want to place focus on as well. So if you look at some other people look at the PEG ratio, which is price to earning growth, that's at 2.1 times. Is that expensive? You decide. Return on equity, 21%. That's pretty good, right? Some people say, no, there's companies with 30, 40%. Okay, fine. So pick your poison or pick your tool. There's no right or wrong. Okay. Or what about the Altman DAX score? This is a great metric to use whether to see whether a company could be at risk of liquidating or bankruptcy. So if you believe in that metric, then maybe you might want to use this. And on conventional wisdom on Altman DAX score is that if it's more than 5, then you're safe. Well, Tencent's at 13.8. So once again, I'll throw the question back to you guys. Is it too expensive to buy Tencent now? If you're looking at PE ratio only, then yeah, probably really expensive compared to Facebook, compared to Apple, compared to Microsoft. But if you were to look at the rest, then it might paint a very different picture. So you need to learn the science of the valuations and then apply your own subjective metric on that, on seeing where you want to analyze and place more focus on.
Yeah, it's a bit of an art and a science, like you mentioned. You need to understand the fundamentals first and then apply your own judgment call accordingly to your own risk appetite.
Yeah, I had a lot of people disagreeing with me about Tencent, but hey, whatever works, we all can invest in different stocks. And you know what? That's why I say don't just take stock tips, right? It's good. You should take stock tips as a tip to go and invest and understand more, but you have to make your own judgment at the end of the day, because 2 people could invest in the same stock, but some people make lots of money, some people lose money. So you have to really, really know what you're doing and have that level of conviction. All right. So aside from valuation, I also look at the management, the quality of the leadership, because I think that's super important, or what my good friend Serging would say, that's the most important, right? So Pony Ma of Tencent, his degree was actually in computer science. We're starting to see a trend here, right? Like a lot of the big companies, the big tech companies especially, their leaders are all from like computer science or engineering. So, maybe that's the big the next big thing for university courses. I don't know. But it's interesting. And, his background, when he first started his career, he was a programmer with a telephone pager service company. He founded Tencent in 1998 with QQ as one of their first few products, and until now, he has about 10% ownership. So I can see he's quite vested in the business. If Tencent goes up, 10% ownership is actually great. That's a lot of wealth that goes into his pockets. Yeah, if he only has like 1%, that would be like, you're the leader, but you only own 1%. Why? Do you not have faith in your own company? So that's what I would be looking at. If he's buying more, that's a good sign for me. If he's selling, I would question, why is he selling? Is it because he has like personal issue? Is it because he no longer believes in the company? So we have to look at all of this and then apply our analysis and judgment. So that takes a look. We're coming close to an hour now, so I really thank all of you who have been sticking with us throughout. But let's take a few questions before I go into the last part, which is additional resources for folks who want to learn more. I see some great questions coming in. Ryan, is there any you want to throw up?
Okay, I guess I have this question that comes through from Patrick Ong. Is value investing outdated? So that's a very interesting debate right now, because when you look at how Warren Buffett has been operating in the past many decades, is his style still relevant? Because things are still, things are so volatile, and now things are different. There is so-called a new normal. Is the value investing, method still, the buy and hold approach still relevant? Because when you buy at the wrong time, and then 10 years later, for example, you might be back to square one. So how much active management should there be when you have a portfolio, I guess?
So I don't think value investing is outdated, but I do know a lot of YouTubers are shouting that out from the rooftops right now and getting lots and lots of views as they do that. I think, at the end of the day, what is value investing? If you had to sum it up in one sentence, here's how I would put it. It's simply buying a stock for less than its intrinsic value, right? And whether or not you buy any stock, you can buy a growth stock. The intrinsic value is that art and science coming in together. And as long as you really understand the business, you can see the future growth, you can see the current success, you can see the addressable market, and you do all of your homework accordingly. Aren't you also, at the end of the day, even if you buy Tesla, isn't that kind of value investing? You can say, no, it's growth investing. Okay, I guess so. You can call it whatever you want. But at the end of the day, people who buy, especially those who are super bullish on Tesla, is because they believe that the intrinsic value of Tesla is fantastic. Now, of course, if you apply conventional methods of measuring this intrinsic value, so some people or some books, they teach the discounted cash flow model. I've never really used that because I don't like all of the assumptions you have to apply in order for it to hold. The moment you get one or two assumptions wrong, right, your whole DCF model falls apart. So I'm not a big fan of that approach. But at the end of the day, the intrinsic value is it's going to be the same regardless of which stock type you choose, right? And I'll use Amazon, for example. Early investors of Amazon, especially those who went in big, believed that Amazon would be a big player in the e-commerce space because of what they were doing. They were losing money in the first few years of their business, same as Tesla, right? And if you believe that that was one of the ways to grow their moat further by capturing all of these consumers and then building that relationship with them and therefore holding and owning that market share, then that would have led you to peg their intrinsic value at much higher than what conventional numbers would have told you. So no, I don't think it's outdated at all. I just think it has evolved. Same as print. Print is not dated.
Hey, Don. So as a follow-up, right, I want to talk about when do you think about cutting losses? Because when you construct a portfolio for your child, it's going to be for a long time. And a lot of things can happen within that long time. What do you need? What thresholds do you put in place to decide, hey, maybe there's a red flag now. I need to get out of this and reposition it and park my money somewhere else. What's your thinking into cutting losses when it comes to building a portfolio for your kid?
So I'll share one really good piece of advice that I got early in my investing journey. You don't have to make back money on the same stock that you lost money on. So cutting losses and then moving. Some people like to hold on because they're like, no lah, just wait, right? But it may be better to actually move it to another stock. And when do I start doing that? Well, Nate is only 2. Okay, so there's not much to speak of right now. But one way why I do active investing is also because I already invest for our own retirement, for my own portfolio. So I basically buy certain stocks, a portion of those stocks, into Nate's portfolio instead. So it's easy for me because I'm consistently monitoring them. The red flag that will come out can be of any kind. It could be maybe a fundamental change in the business. Say, for example, big tech right now, right? If the regulators start imposing really strong legislations, because I think that's one of the biggest risks to big tech, okay, then I think that could change the business model. It warrants a new look into the numbers and the potential profits and the growth that they can earn. So I would then maybe, reduce the stake or move it into something else. And, if there's, of course, signs of fraud, signs of the CEO or the management selling out, then that could be a red flag for me as well. And that's where I'll take a closer look and decide whether or not I am comfortable to continue holding it, or maybe just to move it into another counter straight away. So I don't really cut loss based on a percentage drop. I know a lot of traders do that. Like they say, okay, as long as it drops 20%, then I'll cut loss. But I think in investing, right, actually, if you look at Amazon, go back to the larger, you zoom out into the price history of Amazon. If you had cut loss at every 20% drop, well, you'll be like beating yourself up right now, man. Same for Tesla, isn't it?
Let's take a question from Vescam Chang. So he's got an interesting one. Do you apply technical analysis in your investment? Because we're talking about how it's a mix of science and art, and then went through a lot of ratios, PE ratios, PEG ratios. Do you use charts to figure out when's a good time to get in or when not to get in?
I don't. I know some people do, but FA, fundamental analysis, is already difficult and time consuming as it is. To combine that with TA, right? And sometimes FA and TA goes against each other. One nice way of blending them would be to do FA and then find the good companies, and then use TA to find your entry and exit points. But again, because a lot of my investment style is buy and hold for the long term, only sell if there are red flags that come up that worries me. So I don't really see a need to go and do TA. And let's say for example, if you look at TA, there are certain what do you call that? Patterns, right? That tells you, if it hits this pattern, then it's gonna go down. And if you sell, okay, but that doesn't happen. TA is not 100% accurate all the time either. Then you might end up having to buy in higher, or after you sell, right? There's another problem that investors have to deal with, which is called anchoring bias. If you bought a stock at $1, okay, it's going to be super hard to average up. We like to buy things at a discount. So if I buy at $1, then it goes down, I buy at 80 cents, 50 cents. That's easier to do rather than $1 sell at 150, and then it's 250 now. But I bought at $1 and sold at 150. Why should I pay 250? But your $1 and 150 may never come back. So I don't do TA.
Yeah, but it's a personal choice. If you have the time and if you need another layer of criteria to apply to your own investment decisions, you can. But it is very time consuming, so to speak. So if you're happy with your fundamental analysis screens or filters, that is sometimes enough. And looking at the other questions we have from Sharon. So personal one to you, Dawn. Did you get an education endowment plan for your child, and do you use Money Owl for that?
I shouldn't be promoting products or brands in this webinar, But no, I didn't get an endowment plan for Nate, and I probably will not either. I am going to invest in him. I am going to invest in him instead. Yeah, but I think, because that's the part of Money Hour, I think Money Hour is a great tool to start. I know they have this solution which is for children specifically, and you can actually invest in dimensional fund advisors through them. So if you think that you want to use a robo-advisor to invest for your child, Money Hour has a pretty good solution as well. Yeah, but I don't do endowment plans.
Yeah, so here's another interesting question, I guess, that keeps coming up. It's on price entry again, or entering the markets. And this from Caroline. How do you know when to enter stocks if you don't use TA? And I think a lot of people are interested to find out your thought process. Let's say you're quite bullish on DBS. Do you think about going in before the results are announced, or do you just not care about the results, earnings call or the earnings release, and just go in on a specific day, on a specific time, or do you wait for a trend to happen?
My approach is generally, once I've done enough research and I'm comfortable, I feel I'm bullish, my belief in the company is quite solid already, then I would just buy regardless of the price. But I would also look at how the price has been like. So if I see that it is on a downtrend, then I would first go and find out why is it on a downtrend. Right? Is there a reason why there was a recent crash? So most of the time, right, the price itself is not really the biggest thing for me. It's more of understanding the 4 criteria that I've talked about, and then trying to peg it to what I would value the company at, and I would go in as long as it's below that price. So I don't use indicators. That's for very much TA. I don't think TA is wrong. I think people who have time and want to use FA plus TA to assess when you want to enter the stock, that could be a good way to do it. But the question I would ask is, how much time do you have? Because for me, my personal preference is I already don't have a lot of time, and if I have a spare 1 hour or spare 30 minutes, I would rather spend it analyzing the company and keeping up with the developments and news rather than applying TA.
Yeah, that's an interesting one. So we talk about keeping track of companies. How many companies are you keeping track of, Don? What's in your portfolio? How much is a good target to reach when it comes to building a portfolio? How many are you adding on every year? And is there a target, so to speak, to build up a portfolio to pass on to your child?
No, there's no real target per se. It's moving. It really depends on how many good companies I can find. But for Nate, let me think. I mean, if you count the S&P 500, then that's like 500 plus companies, I guess. But yeah, no, if you look at just like direct equities itself, right? For Nate, I hope not to exceed 10, because I think anything more than 10 would be a bit too much of a hassle for me to maintain on the Excel sheet already. So I wouldn't want to do too much. And I would also, for my own right, then it differs. In Singapore, I have less than 20, I think. I can't remember. And in the US, I have maybe like 10. Yeah. So there is no right or wrong answer on how many stocks. Actually, that's a module on my course. I think I don't know if you have watched that module yet, but I do have one module at the later stages, right, that explain how many stocks should I have in my portfolio. And there is a reasoned approach step by step to walk through that process to kind of decide what is best for you. Because let's say if 30 is too much for you to manage, then maybe 10 is better. But then if you don't sleep comfortably knowing that 10% each is going to each stock, right, then maybe you should make that bigger. Yeah, so it really depends on each person.
Yeah, so it comes down to your how much time you have personally to keep track of all this, or maybe robo-advisors or ETFs is something more suitable for your appetite. And looking at some of the questions we have one on the value of REITs right now. What's your thought on going into REITs in this current COVID-19 crisis? Now, when you look at how there's so much pain and stress going through a lot of businesses, a lot of them might go bust, and more retrenchments down the road. Is it a good time to go into REITs at this point?
Yeah, I think it depends on the type of REITs, right? There's like hospitality REITs, there's data center REITs, there's like office REITs, there's industrial REITs. So if you say that REITs are actually going down, look at Capo DC then. It's really gone down. In fact, it's been flourishing because of the crisis, right? More people online, you need more data servers and all. So it depends on the type. I don't know about all, but I think hospitality is it's like a turnaround play right now. And it really will depend on when we get the vaccine. I don't think hospitality is going to die. Okay, I still think there's going to be a place for hospitality REITs. But the question is, can they survive if the pandemic drags on? Because don't forget, after they find the vaccine, there's also issues of distribution, right? So it may not be that soon, even though Russia says they already have a vaccine. I don't know if we can actually rely on that. But yeah, it's going to take some time. So I would look at REITs that have stronger balance sheets. And hopefully, if their management has actually navigated previous crises before, that'll be even better. But if not, then I would look at what kind of measures have they been taking recently to reduce their gearing, to focus on maybe improving, changing some of the processes. I don't know. I would look at what they've been doing and then decide. But I think commercial is very debatable. I'm completely staying out of commercial REITs right now because I just don't know how the future will look like with more employers realizing, that work from home is actually viable. I don't know if office REITs are still going to be very much as relevant as they always have been for us. So until that becomes clearer, I'm not going to look at it. But I think retail and hospitality is a very clear play. It's just how long will it take to turn it around. So it really depends on which ones. Go for the ones with good quality management, stronger balance sheets, good financials, lower gearing debts, or are managing low interest expense rate ratio, stuff like that. That's what I would look at.
Okay, and here's another question. Which platform do you use when it comes to investing overseas, in US markets, in Hong Kong markets? And I guess just to give a bit of glimpse into your diversification portfolio, how much are you invested overseas versus back home?
That's a good question. I think it's almost 50-50 actually. Yeah, because some of my Singapore stocks has run up so much. Like Riverstone has ×4. So from what used to be smaller, it's suddenly gone up a lot. And then some of the US stocks have also gone up a lot. Some not so much. So I think it's almost 50-50, if not. But it used to be, I think, like 70-30, 70 Singapore, 30 US. Then during the crash, I actually put more in US versus Singapore. So then it became like almost 60-40, and then with the run up, it's maybe 50-50 now. Yeah, but I think for the platform itself, right, I actually just had a recent article on that. So you can search on my blog, sgbudgetbabe.com, or just type in sgbudgetbabe Tiger Brokers. So I am using Tiger Brokers to transact HK and US stocks at the moment. I also have an interactive broker account. And I also do use, I also have local brokerages, but the fees are actually much higher. So I think I would say don't fuss too much about the platform. Yeah, most platforms are almost all competitive. Even iFast and FSM1 is also a great platform. The tools that they have are fantastic. But at the end of the day, if you want access to like Hong Kong and US, right now I'm using Tiger Brokers because it's super cheap. So it allows me to move in and out. I'm doing like some of them, I'm moving positions around. So it helps me at the moment. But for more long-term ones, I tend to use IB for US.
So personally, I have a few brokers as well, and it helps because they send me the research reports from their research department. So it helps me to kind of do my homework on what to buy as well. Yeah. So that's something to keep in mind if you want to get hold of their research reports. And looking at some of the questions as well, I'm just going to sum it up. Some people are interested to know your thoughts on Apple, Ping An Insurance, Kodak. Do you have any views on these stocks? Are you invested in any of them right now?
I'm completely staying away from Kodak, man. I know it was like so exciting, right? When was it? Was it last week or 2 weeks ago? I can't remember.
Kodak went bust. But now they're back in
the... I mean, Kodak went up so much because of the whole $700 million loan that they're getting. Yeah, it's insane. So I'm not
very speculative play on Kodak.
Yeah, correct. So no Kodak for me. And I think right now, I don't know if it's halted or something, right? They're being investigated for potential wrongdoing by the directors. So, and I think they held back the 700 plus loan. So who knows what the future is going to be like. I'm not going to go into Kodak at all, staying away. But I'm watching the drama. It's on my watch list. I just want to see how the price action is. Sometimes this is more exciting than Netflix, I was watching also Hertz and Wirecard during the whole saga. Like, wow. But yeah, so Kodak, no go for me at the moment. Maybe there's a chance. I don't know. For Ping An, I have not studied it enough. But I think Ping An is actually a pretty good counter. I think the addressable market that they have is great. The margins are fantastic. I don't know too much about the management yet, so I can't really make an assessment. So until I have more clarity and I finish my research, my answer on Ping An is still going to be it depends. For Apple, I think it's great. Yeah. And the management quality is fantastic. I think Apple also is innovating very quickly, faster than a lot of their peers. But my only question now is Apple too expensive? I struggle with that a lot because, my first buy into Apple was at $160. And now it's like 400 plus. So I struggle with averaging up just like everyone else. But I'm not as bullish on Apple as I am on some of the other stocks. So I think it really has to depend on the person. If you really believe that Apple's products and services are going to be huge and grow even more, then Apple could be a great one. I know it has been pretty good for a lot of people recently.
Ping An, of course, is the Chinese insurance giant for those of us, for those of you not familiar with Ping An. So those are the questions that we have right now. I think if you have any more questions, we do have a few more minutes to go. So take the chance to ask Dawn all your questions. And if you want to find out more as well, you can go to a website. She covers a whole range of issues, how and where to invest, scams to avoid, and pretty much anything to do with personal finance. So you can visit her blog. So Dawn, I'm just going to give you the chance to walk through what resources people can look out for when they try to navigate this investment world.
Yeah, so I hope you guys found today useful. We covered, we covered the importance of coming up with your own strategy and portfolio allocation first, based on your own personal preference. And once you have that, then the question is, do you go for a robo or ETF or a DIY approach? What tools are you going to use? Okay. And then if you want to learn more, and we walk through, my case study of Tencent and how I approach it. So if you want to learn even more, okay, there are the DIY approach, which is through books. And then that's how I started as well. But I have been going for a lot more courses since a few years ago, because I find that courses really help to turbocharge my learning, and I get to learn from the experience of the trainers, which are not always that obvious in many books that I read. Plus, many of the trainers, because the courses are local, right? The examples and case studies that they give are also more localized, so it's easier to also kind of see where they're coming from. And basically, like I say, I tend to look at what is the secret, and then I will like apply that, right? So I love Fifth Person, for example. I started going for their course as early as I think 2016 or 2017, and it really shaped my investment approach as well. I already had one before that, but it refined that even further. So that you pick your method. DIY, here are some titles that you might want to go and read. If you want to look at courses for a more guided step-by-step approach with case studies that are relevant, I also have an academy on my blog. So if you go into sgbudgetbabe.com or courses.sgbudgetbabe.com, you'll be able to see the different courses and step-by-step approach that I've done. Yeah. So
I think the titles might be a bit blurry. Maybe you can just walk us through the titles
for the books. Is it
for the books?
Yeah, sure. I quite like Think and Grow Rich by Napoleon Hill. It basically just like reinforces your mindset and approach. There's also the Little Book series on value investing, of what beats the market, the little books that builds well. So that whole series is fantastic for beginners. There's also Common Sense Investing, The Most Important Thing by Howard Marks. There's also The Millionaire Next Door, the Richest Man in Babylon. There's a lot of books actually. If you want something more dry, then highly recommend The Intelligent Investor. Although some of you might disagree with some of the concepts and numbers taught in that right now, because value investing is it, right? That's what people are claiming. You have to really make your own assessment. Yeah. So I think also, I think for people who want to know more on specifically investing for parents, right, if you don't mind, I'll just share a little bit more about my approach now. Yeah. So as you have tried out for yourself, that's the Investing for Parents course. I think if whether or not you go through my course or DIY, right, I would highly recommend that you look at the different tools available. So we've already covered ETFs, bonds is my CPF, but there are also bonds and how to read those bond statements. And I also teach that in my courses. There's also REITs, real estate investment trust. The way you look at dividend stocks and undervalued stocks and growth stocks are also going to be different. Like a lot of people use the price to earning ratios for undervalued stocks, but as we have seen from Tencent, using that metrics on growth stock is going to probably cause you to not get invested in that stock at all. So go and learn about the different tools and the science on how to analyze them. And then please go and learn how to read financial statements. There's lots of books out there that can teach you. Investopedia is also a great source. Or even if you want to step-by-step and zoom in onto which line item or to financial statements, you can watch some of my YouTube videos where I do case studies, or even through my courses where I go really, really into detail, more so than some of the other platforms. In my Investing for Parents, right, I'm not sure if you have seen those, but I also have at the last few modules a template for people on how they can adopt that template to create their child's investment portfolio. So I think that's something that's unique. I've not seen anyone done that before, and I thought that's where we can add value for people who are super clueless and just want something that's kind of like a plug and play approach. And also, like earlier on, you asked how many stocks should one have in their child's portfolio. So that's walk through on the course itself, step by step on how to do that. If you're already very savvy, you don't need my course, you can also do it DIY or online. So pick your approach. But if you think that a course method is great, then you can check out the courses.sgbudgetbabe.com. And I have a promo code. Not sure if you think would it okay to be sharing that right now?
Please, what can you share with us?
Okay, sure. So it's 50% off for the next 1 week across any course on the academy. Yeah, any course. So pick the one that you like. If you want something that's like lesser courses, lesser modules to digest first, then there's stuff like on index investing for ETFs, how to read each ETF fund statement. There's also like on REITs. So get 50% off any course of your choice by typing half price.
Half price. So that is the promo code.
Yes, half price. Only for 1 week.
Actually, went through your course. I didn't get time to go through everything, and I just want to emphasize that this 1 hour that Dawn has helped us to walk through is an extract of a long webinar module that is, if I'm correct, 8 to 10 chapters long, and inside each chapter there's mini chapters as well.
Yeah, more than 50 plus lessons, so it's gonna take you a while to complete them, right?
I'm not sure, half a day or 1 day to go through everything.
1 day.
Okay, so that is pretty much what else you can look out for. This is just 1 hour, a quick summary of what you can expect in that course. And I want to thank everyone again. So once again, this is a very useful session for everyone who will kind of have a kid. And I'm just looking through some of the earlier answers just now. Many of you have young kids from 22 months old. Some of your kids are now 21. So many of you have some experience already in planning for your kids' futures, and some of you are just getting started. So I hope today's session is helpful in giving you some thoughts on how else to manage the what's to come in future when things are getting more expensive, when university fees, is such a huge question mark, how much it will be. Maybe your kid might take up medicine or not. So that is a lot of things to kind of manage. And you, of course, if you start earlier, it is going to be more helpful. And I think we've got a lot of ideas from Dawn. So of course, in the comments page, we do have a feedback form for you. So if any feedback on what you want to hear more about in future or from Dawn herself, you can also put it in the comments. So one lucky winner, if you give your feedback, we'll walk away with a goodie bag of Money FM merchandise. So please take some time to fill out the feedback form. And also, if you want to find out more, next week, next Friday, we will have another webinar. And this is about understanding the stock market. And this is with my colleague, JP Ong, and he will be with SGX market strategist, Jeff Howie. So stay tuned for that. And otherwise, you can also find out more about Dawn's podcast. I think some of them are on your website.
That's great. Yeah, lots of free resources on my website as well.
sgbudgetbabe.com.
Mm-hmm. Yeah,
How
thanks
do you know the name Budget Babe?
Oh, it was actually just random. Yeah, there really wasn't much. Like, it really, literally, really just popped into my head. But you know, a funny side story is that when I first started, right, I didn't know that there's another influencer called Bong Choo Choo who's called Budget Barbie. Because I know her as Bong Choo Choo, right? I don't really follow her much back then. So yeah. And then suddenly people are like mixing me up with her. So I was like, oh no. So I had to, because my email, right, for those of you who have emailed me before, is sgbudgetbarbie@gmail.com. So then I was thinking I was so smart for coming up the name Budget Barbie. Then I realized someone already took it. So I switched that to Babe. Yeah, but it keeps it mystery, right? I think it's really just random. But I think at the end of the day, whether or not you're on a budget or not, in the beginning it was all about like cutting my budget and saving more. But I soon realized that saving is not enough. So that's where we would need tools like investing or endowments or whatever you pick to really grow our money more.
Yeah, and of course it's been how many years already? And now you have 10 million viewers every month.
No, in total.
In total.
Yeah, it's been like 6 years. Yeah, I think every month the website gets anywhere between 200 to 300,000. So I'm super appreciative and thankful of that.
Okay, and we are just going to wrap things up now. I think we don't want to hold you back from your Friday evening. Thanks again for everyone for spending this Friday with us. And if you want to find out more, just write into us. Thanks a lot for taking the time to join us on today's Money Matters webinar.
Thanks.